Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and the Reserve Bank of Australia has just come out and, as expected, raised the cash rate by 50 points to 2.35%. The most important aspect of this, which many in the market are probably not fully appreciating, is that at these levels, the Reserve Bank's settings are still stimulatory. In other words, the Reserve Bank is still feeding inflation at this point. If you can take that point on board, that gives you some idea of how many more rate hikes are ahead of us. Now, I hope you've fixed your mortgage rate. We've been saying it for a year to do so. But at 2.35% for the cash rate, we could still have another 200 points more. That's another 4 50-point rate hikes from the RBA over the next 4 meetings. So just do look to do something about that. In terms of the financial market impact of this, well, of course, a lot of it depends on the accompanying statement. And just having had a read of what Governor Lowe had to say, it's very much economics 101. There's nothing too ingenious in there. He is a little bit optimistic about the state of the Australian economy because, like most economists, the Reserve Bank is thinking that you still treat employment data the way you did last century. But post-COVID, low unemployment, high job vacancies merely highlight the dislocation or the dysfunction, if you like, of the underlying economy and are not something to be terribly proud of, that bizarre combination. Also, there tends to be a little bit too much emphasis, from my point of view, on the idea that some inflation is actually demand-driven. Yes, it is, but let's realize that we shouldn't approach this as an all-encompassing demand-driven inflation problem. And the statement does give tribute or pay attention to, is the more appropriate word, to the conflict in Ukraine and energy supply issues and the importation of inflation, certainly from around the world. The Australian dollar, I'll do equities first. Equity markets, they've just sort of taken this in their stride for the moment. That could see maybe some attempt to rally into the close on the day for Australia, but I think in coming days, coming weeks, the Australian stock market will still be a sell. It is very evident from the accompanying statement, more rate hikes to come. There is a focus on fighting inflation and getting it down, and this is in the statement, back down to 2 to 3%, but their expectation for that is in 2024. So they've gone from saying they'll never raise interest rates until 2024 to now saying inflation will be too high until 2024. So where are they going to hike rates to? I've said all along there is a risk the Reserve Bank will raise interest rates to 4.5% or 5.5%. Doesn't mean that there might not be a pause after the next 100 points. So we're probably going to go up to about 3.35% for the cash rate. Maybe there have a brief pause, but then again, I think kick on for another 100 to 200 points after that. So a lot of central bank tightening, higher interest rates. The mortgage stress, we've only seen the very tip of the iceberg. It hasn't even begun yet. We will have significant mortgage stress in this country, in Australia, by the end of this year, and certainly around the middle of next year will be a real crunch point where you will begin to see, if you haven't already, forced property sales in Australia. So the property market outlook is not very good. That loss of wealth or just that stress and strain on people, even people whose property portfolios are particularly themselves stressed, will be concerned that the property market has turned down, and that downturn is only going to be intensified by the RBA continuing to hike interest rates 50 points each meeting. Certainly the next couple of meetings, I would suggest to you. In terms of the equity market, though, I think it is a sell. I think the economy will slow due to mortgage stress. it will slow also as businesses begin to struggle, because a lot of businesses leveraged to create and generate and grow market share on the idea that interest rates would be flat until 2024 as well. It wasn't just property borrowers, and I think there's going to be some business stress out there and a lot of companies pulling back on purchases they don't really need to make in terms of equipment or supplies until further down the track. So I do think there is, and I'm one of the few economists in Australia, maybe the only one, saying there is a real risk of a recession in Australia in the next 6 to 9 months. So watch out for that. That will catch the market by surprise. But the equity market might be just starting to get this idea, because it has been flat so far on the day. And I think the equity market over coming days, if it begins to turn down, be mindful that the equity market has started to figure out there could be a recession coming in this country. So watch out for that, because that could snowball into a very sharp downturn in stock prices. For the currency, it's been fun to watch, only because I've been there at the coalface in my career. The interbank dealers trying to set off the stop loss orders on both sides of the market, on the downside and then on the upside for the Australian dollar, because that's where they can make good profits for their bank on the day by setting off, getting the price to move through, and all these stop loss orders get done, and it's very easy for them to make a profit on the transaction of a stop loss, a lot easier than it is on the transaction of a take profit. So there's certainly some of that going on. Why we've never had an inquiry into that, I do not know. Monday mornings in particular, that's certainly what happens. Hence we get volatility. I remember a couple of years ago, the Australian dollar fell 2 cents or something in the morning session and then bounced back in a couple of hours. And why there was never an inquiry by the Reserve Bank into that pricing activity, I do not know. Begs the question. But on the day, yes, setting off stops either side of the market, volatility. But in the end, this 50-point rate hike by the RBA, even though the accompanying statement says there's going to be further rate hikes, merely confirms that the Australian dollar, US dollar interest rate differential is going to get worse for the Australian dollar. In other words, it's just going to become even more expensive to hold Australian dollars. On the day, the knee-jerk response is, oh, we got 50 points, buy the Aussie dollar. No, you're still going to be another 25 points meeting on meeting with the Federal Reserve, worse off in terms of the carry cost on holding Australian dollar positions. So it is in fact a negative for the Australian dollar, and I think most market participants will trade it that way starting within 12 to 36 hours of the event. So I am bearish property, I am bearish the economy, I am bearish Australian equities, I am bearish the Australian dollar. And isn't it great we live in an age where the instruments are there, where we can also profit, make money in falling markets in the same way as we can in rising markets. And it's so important to protect your investment portfolios, and it's very important to be aware of that fact. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.